Happy New Year and happy Tuesday. Welcome back to the first market update of 2024. Today is January 2nd, 2024, and this is your Tuesday market update. As I mentioned last week, please keep an eye out for changes to the distribution plan for these videos. More to come, but if you watch often, I don't want you to miss anything. Just last week, I missed an email because they switched the address it was coming from, and it got spit out of my normal email. So if you're watching, thank you, and I don't want you to miss anything, so watch out for that. Let's recap the past week, and let's preview the upcoming first week of 2024. First, let's start with the information I previewed last week. What will the fuel of this market be in 2024, and what direction will the engines drive us? The week before last, we had another positive week in the market, but in the middle, literally, we had a major reversal late in the trading day on Wednesday, and I want to give some thoughts on why and what to expect as we go into this year. To refresh your memory, we were on track for another up day on the string of up days, and then at about 2:30 p.m. Eastern, all the buyers left town all at once, if you can call them that. The chasers and the FOMO crowd all dried up at one time. I want to give two possible reasons for this action and put these in your mind for the coming year. In my opinion, the moves were a function of a few things. First, earnings, and second, the hangover of a screaming market up over 15% in 6 weeks. So as we go into this year, we'll need to watch earnings. We're about 2 weeks away from the earnings season starting again, and this will be important, not only in what they report from Q4, but as always these days, what they say about what they are seeing for the coming quarters. The bar has been set pretty low for the earnings, but watch out for guidance. And as we saw last month already, FedEx and Nike, for example, got clobbered when they lowered forward guidance. As for market moves to date, this will play into valuations. And as the famous economist John Maynard Keynes said, the market can stay irrational longer than you can stay solvent. So when it comes to earnings and valuations, I want to point out that if this soft landing the Fed is trying to engineer, as hard as it is, let's just talk about it for a second about what happens if it works. A soft landing is good for the Fed, obviously. Overall, a soft landing means slower growth than we're seeing now. And that's where I think there is risk. We do not have to hit a huge air pocket in growth to hit earnings. As inflation was high and consumers kept buying and paying more and more for goods and services, that allowed for better margins and better profits. As inflation recedes and the growth slows, margins may contract and profits may come down also. Now, this is not a sure thing. This is just a risk. As I started with this line of thinking, the risks are what we need to watch for. It's always best to prepare for the flood before it starts to rain. We'll watch this and so much more together as we go into 2024. So now let's recap last week and we'll preview the first week of the year. Last Monday was, of course, a market holiday for Christmas, so we were able to keep the momentum at bay at least until Tuesday, when the path of least resistance and the momentum from the recent move carried us into the last week of the year. There was quiet heard around Wall Street as the desks were more empty, and that got more quiet daily as it went along. Being nearly void of catalysts, the markets would have needed something big to move it off the rails, and that was just not to be on Tuesday. Newswires were focused on upticks in geopolitical risks in the Red Sea and housing data. The market didn't care. Overall, there was nothing to challenge the bullish tune. Stable growth, dovish Fed, and falling inflation. By the end of the day, all three indices were up about 0.5%. Small cap Russell 2000 was up another 1.5%, continuing a spike upward in the past week or so. The sleepiness in the market continued. Wednesday, things got a little bit more quiet and volumes kept falling. Nothing was there to break the momentum, so the drift was higher, like cutting the engines of a boat and just coasting into the dock. Strong 5-year Treasury auction did give a bit of wind to the sails, but only a bit. By the end of the day, quiet day. The Dow was up 1/3%, the S&P up a bit over 1/10%, and the NASDAQ was up just under 1/4%. If you're a fan of the 80s movie Ferris Bueller, you'll recall the attendance roll call, Bueller. Well, there was no answer on the trading desk on Thursday. It seemed that we said this last year too. For similar reasons, another tough year, and it was time for a rest. Once again, there was little on the news wires. Jobless claims are pretty much in line. Even the continuing claims were not enough to move things. There was a brief note of the ugly 7-year Treasury auction, but like most else, last week it was ignored. Very little report. Dow up 0.1%, S&P and NASDAQ virtually flat. Friday started as I've been describing, little change. I'll admit it was annoying to see all the this year oil ended down 10% type headlines a good 7 hours before trading for the year closed. Certainly, as someone who reports numbers on these videos, I don't count on any of these numbers to end the way the day starts. By the end of the day, the Dow actually did finish lower on the day, just 20 points or 0.05%. Barely. The S&P was down about 1/4%, and the NASDAQ was down 0.5%. For the week, the Dow was up 1/3%, S&P up about 0.75%, and the NASDAQ was up just 0.1%. After the close, now we can wrap up the year-end numbers. After a very ugly 2022, 2023 was the other way. And as such, we're about where we were before 2022 started, at least pretty close. For 2023, the Dow was up 13.75% and a new record close. Excuse me, the S&P ended just short of a new all-time high, the record that we set, you guessed it, January 2022. As I said, S&P up 24.25% for the year, and the Nasdaq was up 43.25% for the best year since 2020. But not an all-time high yet. I want to wrap today with a look into the markets of 2024 and just the first of what will be a lot of thoughts in the upcoming year. We know that every year is different. Heck, in most cases, every week is different. But the wind in the sails of 2023 will change in 2024, and I want to point out a starting point for this conversation. This may sound strange, but the falling yields will not be the positive for the stock market we saw in 2023. As we've been discussing since mid-December, the Fed pivot, as it has been called, will bring rates down. As far as the market is betting, now two things on that. First, this is baked in to a large degree. The market seems to have priced in up to 6 or 7 cuts this year, so any deviation from that will prompt selling, not buying. First, any pushback on this idea will be negative for the markets, and any increase in that will certainly worry the markets that there are growth problems ahead. Also, to add 2 notes to the forward expectation. First, it comes from the dot plots that were released by the Fed in December. As you may have heard me say a lot, this is nothing but expectations, and you know what I've told you about Fed forecasts. They've been wrong so often. The dot plot prior to the December release still had another rate hike shown. And no cuts. So they changed a lot. And finally, as Professor Jeremy Siegel from Wharton pointed out last week in his review and preview of the markets, when everyone, including me, quote that futures markets are betting on 6 hikes, he points out that the future markets are not an unbiased estimate of futures rates. This is future rates. This is a place where a lot of asset managers use futures to hedge their portfolio. So let's just not take them as 100% proof. It's just one man's read on that. Finally, let's preview the week ahead. We've already moved into the week, jobs week again, and just a few short weeks from earnings starting again. Today we will get some manufacturing data as well as some construction spending. Tomorrow is hump day already, so you'll get some Fed heads starting with Barkin scheduled to speak. We'll also get JOLTS, auto sales, and December Fed meeting minutes. And I actually think you'll have to watch out for these minutes. Remember, Powell said they're talking cuts. And then we had other Fed heads saying they were not. So let's see what the minutes reflect. Thursday, we'll get more labor data and ADP and jobless claims, initial and continuing. Remember, the continuing claims have gotten some people's eye recently. We'll also get some services PMI. Keep an eye on that important service economy. Finally, Friday is the headliner for the week, unemployment report, hourly wages. This read on the labor market will be closely watched by the Fed and more specifically the Fed watchers. So I continue to refer back to what I said a moment ago. I think this will shift somewhat to earnings unless we get major inflation news, which I don't think we'll see. So come back Friday for the first planning video of the year and back again next Monday for the Monday market update. Have a great first week of the year, only 4 days until the weekend.